The bull and bear are not animals you'd encounter in the wild in the realm of investment. Instead, they reflect public opinion about the economy, corporate performance, and the potential for investment returns. Typically, the conditions kick in when investment prices rise or fall by 20% or more. Because investment markets are complicated and ever-changing, understanding what to expect from different market cycles will assist you in making informed investment decisions and developing a resilient investment strategy. Whether you understand these terms or not, both bear and bull markets will have an impact on your portfolio. The origin of the bull and bear symbolism? Before delving into the specifics, it's crucial to understand why these animals become icons for two market attitudes. A bull is used in finance to characterize a market on an upward trend, since the tendency matches the fighting style of bulls, which charge with their heads lowered only to elevate them in an assault. A bear, on the other hand, faces downward during a fight, in the same direction as a bearish trend. What is a bull market? A bull market is one in which prices continue to climb indefinitely. During a bull market, demand outweighs supply because market confidence is high, and the majority of investors are buying assets and make long-term investments with confidence because they believe in the market's growth. When the market is bullish, economies prosper, resulting in higher employment rates and increased expenditure. The enthusiastic behavior of investors, combined with an increase in prices, is a solid predictor of the commencement of a bull market. The Fear and Greed Index can be used to gauge investors' level of optimism or pessimism. To be positive that you are in a bull market, look for a 20% or greater market advance that lasts at least 2 months. This recommendation is based on the Securities and Exchange Commission's definition of a bull market. It is critical not to assume that what you are experiencing is a bull market, as market corrections and brief trends might confuse you. So, what is a good illustration of a bull market? According to CoinGecko, Bitcoin, which was priced at $10,000 at the time, began a bull run at the end of 2020 that ended with an all-time high above $68,000 on November 10, 2021. What are bear markets? When investment prices decline for an extended period of time, usually 20% and more, it signifies the market has dropped into bear market territory. As investment prices continue to fall, investor confidence drops, and a negative sentiment grows, driving the value of securities down. Bear markets can be triggered by global events, a pandemic, for example, and contrary to bull markets, are often accompanied by a weak economy and higher unemployment. It is common to confuse a bear market with an economic recession. Although the two generally go hand in hand, they are associated with different issues. The former describes a stock market decline due to negative investor sentiment, often caused by fear or uncertainty. The latter is a slowdown of the entire economy, a significant decline in economic activity and GDP. Economic recession may cause a decline in investment prices, but there are other factors that may affect investors' outlook and cause market fluctuations, including natural disasters, pandemics, etc., wars and conflicts, government policies, concerns over inflation and deflation, technological changes, corporate performance, interest rates. Unfortunately, bear markets can occur at any time and without warning, so investors can be easily caught off guard. While it is very difficult to predict when the next bear market will take place and for how long it will last, one thing is historically consistent: bear markets happen and are a normal part of the long-term investment cycle. Since both bull and bear markets are difficult to predict, investors can typically only recognize the phenomenon after it has happened, thus the labeling of these unique market conditions is done in hindsight. Investing in times of increased market volatility. Uncertainty in the market can naturally generate fear and lead to poor investment decisions. Many investors are affected by widespread pessimism during bear cycles and strive to sell their shares as soon as feasible. Keep this in mind and avoid selling out of fear. Keep in mind that bear markets are much shorter than bull markets, and returns in bull markets have historically been bigger than losses in bad markets. Long-term investors can also benefit from bear markets by purchasing investments at a lower cost. Can there be a deceiving market? When attempting to forecast whether a bull or bear market is imminent, keep in mind that not all long market movements indicate one or the other. Periods of stagnation, you see, are also possible. The market is attempting to find direction in them, and the multiple upward and downward movements that occur essentially cancel each other out, resulting in a flat market trend. Bad investment if you jump to conclusions and confuse a flat market trend for a bullish or negative one. Where did the terms bulls and bears originate? While the terminology is straightforward, the impact of a bull or bear market on your portfolio and wealth is apparent. Because both creatures are recognized for their enormous and unpredictable strength, the image that each creates in terms of stock market volatility is unmistakable. Interestingly enough, the actual origins of these expressions are unclear. Here are two of the most frequent explanations given. One, the terms bear and bull are supposed to originate from how each animal attacks its opponents. A bull will raise its horns into the air, but a bear will swipe down. These behaviors were then figuratively linked to market movement. A bull market was defined as an upward tendency. It was a bear market if the trend was downward. Too historically, bearskin middlemen would sell skins that they had yet to receive. As a result, they would speculate on the future purchase price of these trapper skins, hoping for a reduction. The trappers would earn from the spread, which is the difference between the cost and selling prices. These intermediaries were dubbed bears, short for bearskin jobbers, and the term stuck to describe a market collapse. In contrast, because bears and bulls were commonly thought to be polar opposites due to the once popular blood sport of bull and bear fights, the term bull stands in for bears. In bull and bear markets, how do you invest? A bull and bear market cannot be treated in the same way since their conditions are so different. In a bull market, it is critical to enter early and exit before the high. You can rest because market losses are minor and the opportunity of making a profit is greater. If you want to experiment with volatile assets, a bull market is a time to do it. When it comes to bear marks, losing money is more likely, thus you should opt for safer investment choices like short-term trading, staking, lending, borrowing stablecoins, and so on. A bear market is also a good time to buy profitable assets you plan to hold for the long term. But, when doing so, be wary of bear traps, sharp declines in the market that force participants to sell ahead of a reversal. The bull and bear market has been explained to you. Thanks for watching.